obviously coronavirus, markets, individuals being affected across the world, these thoughts are probably as pertinent today as they've ever been. Firstly, markets. Obviously, mid-March many markets fell up to about 20% across the world, whether it was emerging markets, developed markets. Since then, we have seen quite a sharp recovery. Not so much in the UK stock market. You can see from this chart that the line on the bottom where we compared the FTSE All Share, which is the main UK market, the US main market, the S&P 500, emerging markets, Europe and Japan, you can see the standout winner has been the United States, and the standout loser has actually been the UK. Now, part of that has been the fact there's much less technology stocks in the UK, and there's more banks and other financial institutions which have been harder hit than other companies. But there has been, as we'll see later, quite a sharp derating of UK equities. As I was saying, in a way, we've seen two markets this year. So there's four lines on this graph. The top line is the FANG Plus index, and you might wonder what's a FANG Plus. It sounds quite scary, but it's the traditional FANGs, which is Facebook, Apple, Amazon, Netflix, and Alphabet, which used to be called Google, plus some of these highly traded growth stocks like Alibaba, Baidu, Nvidia, which is currently buying ARM in the UK, Tesla, and Twitter. And you can see the year-to-date performance of those stocks has been quite astonishing. It's up 87%, which is even ahead of technology stocks worldwide at 35%. And then the whole world stock market, which, if you remember, more than half of the world stock market is the US index, is actually up this year. And the kind of old-fashioned stocks, you might say, the value stocks, but these are simply stocks where if you value them on traditional multiples like price to book, price to cash flow, price to sales, price to earnings, so rather than the very high valuation growth stocks, those stocks have underperformed considerably, and they're down more than, well, nearly 9% as we speak. Now, has it gone too far? Only, in a way, you will only know in retrospect whether things have got too far. But there are a lot of, let's say, warning signs, and I've just said, not on this slide, but two of the warning signs recently were the fact that both Tesla and Apple announced large consolidations of the shares, which basically meant they issued more shares, which then had the effect of getting the share price down. Now, in theory, that should not affect the valuation of the company, because all that's happened is there's more shares, so a lower share price, but the company is exactly the same. And there is a lot of academic research showing that these share splits are associated with small rises in share price, but not the extent you saw in both Apple and Tesla, where it led to a kind of frenzy in buying by private investors in the States as a result simply of the share split. Now, if you look at Apple, and again, looking at fundamentals, Apple is obviously a fantastic company. There's no dispute to that. It's a leader in its field. It makes very high margins, has prodigious cash flow. Nobody is doubting the fact that Apple is a high quality company. The question is, has the stock market, in a way, put everything in the shop window? And if you look at this chart at the top, you can see the price earnings ratio of Apple against actually the year-on-year revenue growth. And you can see, which is completely understandable, as Apple grows to be a larger and larger company, its rate of growth is bound to slow down. And when you put on top of that the fact that the the main market that Apple addresses, which is obviously mobile handsets, is maturing, and that its market share being dominant is unlikely to increase. As you can see in the bottom table, the number of Apple phones, and the phones is more than half the revenue as we stand today of Apple. So despite other entering into wearables and other markets, there's still the dominant profit earner and the dominant revenue earner is the sales of phones. You can see the sales of phones is slowing, the revenue is slowing in that top graph, the blue line, but the valuation is actually going up, and is actually going up very strongly. So for quite a number of years, Apple was considered a value company because people viewed it as a kind of low growth company, relatively mature, and was on a P of 8 to 10 times. Now, ironically, where the growth is slowing, it's actually on a P of 35 times. And at one point recently, Apple was worth more than the top UK stocks, the top FTSE 100, the 100 largest companies in the UK. And on the right table, you can see in comparison, whilst the US is obviously, as I said, the dominant market worldwide, if you put Apple as a kind of market, Apple would be almost equivalent to the UK, France, and other large markets. And what we thought would be interesting is actually look at, which is something that kind of Warren Buffett has always talked about, is what you actually get. So Mr. Market determines the price of anything, but the question is, what is it that is the real fundamental value? How much sales are you getting for every pound you invest? How much profit are you getting? How much cash flow? And if we look at the consensus estimates for the top UK 100 companies, because essentially at one point very recently, we were saying the top 100 UK companies is worth the same as Apple. You can see the multiple of revenues of those FTSE 100 companies per pound you buy is nearly 8 times. And the multiple of profits is on this year, which is obviously depressed earnings for many UK companies, 2.5 times, and on forecast for 2 years out is just under 4 times. Now, one of the predictors of returns, and actually from research at Vanguard produced quite a number of years ago, where it looked at different factors and how each factor was a reliable indicator of future growth. Now, one of the interesting things, which is not shown here from that table which Vanguard produced over a very, very long period, is that whilst everybody talks about economic growth and GDP growth, the one factor which actually was a greater predictor than any other factor was the CAPE ratio. Now, what the CAPE ratio does is basically average the profits of companies. So it's the profits averaged over a large number of years and look at that multiple of earnings. And if you look at one at the other hand of GDP growth, that actually had a very small forecasting ability. In fact, the likelihood of that showing you what future returns was going to be was the same as looking at global rainfall, it turned out. Whereas actually the biggest determinant was, in a way, is common sense, is how much you pay for something. If you pay a lower amount for something, then actually it tends to be the probabilities are stacked in your favor and your returns are going to be higher because you're not paying much for something. And if you look at the UK and the US on this CAPE ratio, you can see the UK is towards the bottom of its multiple based on the 10-year average earnings, the CAPE ratio. Whereas in the US, you can argue partly it's because of a greater representation of tech stocks, is on a much higher multiple. And the forecasts underneath are not our forecasts. These are a company called Research Affiliates, and Research Affiliates put into their matrix lots of different variables and forecasts, and they determine based on the yields you're getting, the likely capital growth, the likely valuation change, what the forecast returns are. And in terms of forecast nominal returns from the UK, this is not our forecast. They estimate a forecast return of about 9% per annum, whereas in the US, it's about a third of that. Now, part of that in the US is simply that bottom factor, the valuation change, because the shares are so highly valued, it's unlikely that that valuation multiple is going to be sustainable. Again, if you think back, and over much of the time since SCM has been in existence, one of the biggest and most important factors has been how much have you got in the US in determining your performance. And for many years, the US has outperformed virtually every other market in the world, every other major market. Well, recently, that outperformance seems to have stabilized, and actually over the last month has come back quite dramatically. Part of that is because some of these large mega cap growth stocks have come back, like Apple, over the last few weeks. I mentioned before the performance of value companies, those value stocks, which are just companies which on old-fashioned principles are lowly valued. Now, those stocks have been so out of favor, it's been quite astonishing. They've hit basically more than decade lows. We have a slant within our portfolios towards these kind of companies in the various index funds we buy, because we believe that's where the real kind of opportunity is for getting the highest returns going forward. It's interesting, in September, so far, you can see they're having the best month they've had for nearly 20 years. We don't think that's a temporary phenomenon. We think whilst there's bound to be blips, and part of it will be on people's expectations for the economy and other factors, but over the medium to the long term, we think you're going to get much higher returns from those companies than you will from some of the mega cap growth companies. Which brings us back to what we hold in the portfolios. Yes, we do hold index funds, but we don't hold index funds just for the sake of it. We don't. A lot of managers with portfolios holding index funds simply buy, if you like, the 100% the traditional index funds. We don't do that. We have slants in our portfolios, whether it's to emerging market equities, whether it's to small companies in various markets, whether it's to more value-driven companies in various markets or high-yielding shares. We can do that, but we do that via indexes. So, I mentioned the US. In the US, we don't hold an S&P 500 index fund. We hold index fund value, investing in value-orientated companies. And therefore, if you look at the underlying number of holdings we have in the equities component within the various portfolios, you can see that it's very well diversified, but within that, there is definitely a slant, a bias towards higher yielding, lower demanding in terms of the price, the underlying book value, lower demanding in terms of the price earnings multiple, and the growth rate is similar to the overall market. Now, coming back to economic growth, this is a table which was produced only a few days ago by Deutsche Bank. And I think the factor to look at here is the fact that actually in September, and this was 2 or 3 days ago, the actual economic growth forecasts were higher than they were at the kind of low point in after March, April, when we had kind of global shutdowns and people were very gloomy. Part of that is obviously the effect of huge stimulus around the world, fiscal stimulus and monetary stimulus. And you can see actually the economic growth varies quite considerably across countries. The UK is not particularly good on here. You can see that the Bloomberg consensus is for minus 10% this year and plus 6.5% next year, whereas for the world, it's minus 3.8. So some economies are forecast to do worse than others. What is interesting, if we get on the next slide, is on the bottom right, is actually some of the emerging markets, particularly China. The irony, they kind of, given the situation we find ourselves in today, actually China has been one of the strongest economies in terms of the markdown this year, and actually is one of the few economies which will actually bounce back to much higher levels in a very short term. Whereas in the advanced economies at the top, I mean, it doesn't look like there's a large gap between that, but the US is the strongest within that, and some economies like Spain and the UK are towards the weakest within that. Now the stimulus, sorry, just to go back, the stimulus level on that left graph, you can see it puts it into context with the amount of money going into the economy. And that is definitely having an effect. You can argue whether that's simply reducing the economic carnage there would be otherwise, but at some point that should help the economies. Going on now to the world of bonds. If you were to say to somebody, can I borrow money off you? How much do you want to pay me for it? I think, and you were to say, actually, I'll lend you money over 5 years, and for that, I'm not actually going to pay you any interest. You might think that person was absolutely mad. But here we have the UK government where investors are currently lending money to the UK government with a 5-year negative yield, as you can see there, 0.3% per annum, moves into positive over 10 years, so you get close to 0.2% per annum, and even over 30 years, you get 0.75. In the US, the yields are higher, but these are still very low yields. So if you look at that bottom chart, you can see the long-term history of the UK government yield. And we believe there's much more attractive assets in the world than other UK or even US government bonds. One thing which is a result of these very low yields of some of these government bonds is that in the past, your fund manager or advisor might have told you that bonds were much less risky than equities. And the main measure of risk that most people use is the volatility. But if you're investing in a very long-term government bond, and the yield on that bond is very low, and the length of maturity is very high, then essentially only a small change in interest rates can have a dramatic change to the value of that bond. And you can see on this chart, which is over quite a long period of time, 2017 to 2020, the volatility of various bonds. These are prime government bonds. So for example, the Swiss government bond has the same level of volatility almost as global equities. The Italian government bond, which you might think would be, sorry Massimo, quite a volatile government bond, has a similar level of volatility to Chinese equities. And also on that graph, the corporate bonds are actually much less volatile. Now you might think that actually corporate bonds would be more volatile because you have more risk of corporate default, whereas the governments aren't going to default. But part of this is the fact you start off with a much higher yield on corporate bonds, and part of it is the fact that a lot of central banks have been stimulating or putting money in quantitative easing by buying corporate bonds. So the corporate bonds actually give you a higher yield, and recently have actually been less volatile. Again, if we compare, if you like, the traditional market with what we hold in the portfolios, you can see there's quite a difference. So again, we have a very wide diversification in the portfolios. The amount which is in bonds is very well spread. It's a few thousand corporate bonds and nearly 1,000 government bonds, but these are not Western government bonds. These tend to be emerging market government bonds. The yield there is 2.5% per annum, so it's nearly 3 times the average bond in the world. The duration or the maturity is actually shorter. So because you have a higher yield, and because the average maturity is shorter, the effect on that, which is this modified duration, is that you have less risk to changes in interest rates. The other factor, which has been probably one of the most important over the last few years, particularly for obviously a sterling investor, is the exchange rate. We obviously saw a dramatic fall in sterling after the referendum. But where are we now? And one of the things we always look at is purchasing power parity. What that looks at is basically a basket of goods in two countries and said, if the value is the same, what would be the exchange rate? And there's different ways to do this. So you can do it on the basis of the consumer prices for goods. You can do it on what's coming out of the factory, the producer prices. Big Mac isn't a mistake. That was something which the Economist, I think, dreamt up quite a few years ago, where one way it thought of comparing currencies is to see how much it cost a Big Mac in different places in the world. I think Switzerland is one of the most expensive places to buy a Big Mac, and Russia's one of the cheapest. If we take all these different comparisons and we average them and say, what would that make the exchange rate for the dollar and the euro, you can see the pound looks about 18% undervalued against the dollar and about 8% undervalued against the euro. Now, that doesn't mean it's going to go to those levels tomorrow, but it should always be in your back of your mind what the underlying value is for making investment decisions. And talking of investment decisions, we have been pretty proactive over the years in terms of currency hedging. Now, prior to the referendum vote, we never bought a single hedged product because at that time we thought sterling was fairly valued. But after sterling collapsed, that was the time we thought, if ever there's a time to, if you like, protect the portfolios, reduce that currency risk, that was the time to do it. So we bought substantial amounts. We changed various ETFs into a currency hedge version. So you can see that on those blue lines on the left of the chart. And then surprisingly, maybe about a year and a half after that, there was a lot of optimism around kind of trading in the deal and other factors. And the pound nearly recovered to actually the level it was before the vote. We took advantage of that and we then took off quite a lot of those hedges. And again, there was a low point about a year ago where again, the pound was completely out of fashion. But one of the factors this year, and part of it was normally when you have market meltdowns or panics, there tends to be a natural kind of movement into the dollar. So the dollar tends to benefit at those times. And the pound did fall substantially during mid-March. And we did actually time that decision, you know, so far. I mean, we don't know what's going to happen tomorrow, but so far, very positively, we increased significantly the amount of dollar hedging. We also hedged a lot of the Japanese equities from a Japanese yen into a Japanese yen hedged product. Now, you might think now is not the right time to invest because of what's going on currently with coronavirus. And I have to say, whatever people's thoughts are on coronavirus, unfortunately with markets, they're always worrying about something. Now, that something changes over the years. And this is a survey from Bank of America of fund managers and their largest worries at the time. You might say fund managers are paid to worry, but the subject of their worry changes considerably. So for many years, they were worried about China hard landing. If you remember, there was talk about the fact that the amount of money that China had spent on infrastructure was completely wasted. All these cities with nobody in. We had worries over whether the euro was going to collapse. We've had worries over trade wars and Mr. Trump, and particularly between the US and China. We've had worries about whether, if like quantitative easing, that was the last piece of kind of ammunition that central banks would have had, and what happens next. And now we have the risk of coronavirus and the impact on economies, and obviously the levels of government debt worldwide. I'm not in any way minimizing it. All I'm saying is it is a constant in markets that there will always be worrying about something, and that shouldn't really put you off from investing. The question when investing, I believe, is to ask yourself, can you kind of ride those volatility of different worries and different factors in the future? And a great way to do that is to have a very well diversified portfolio. And what is the price you're paying for something? Because if you buy assets at a low price on low demanding valuations, or particular assets where you perceive there to be great value, then that's going to give you a level of protection. If you simply buy, like at the moment, government bonds that yield you nothing, then over the long term, you're probably actually going to get less than nothing because of the fees and charges associated with investing in that. So I always say you need to look at what it is you're buying, the price you're paying for it, and the risks attached to that. Just, I don't know how many people saw the Witty and Balance presentation yesterday. One of the few areas of positive that came out for that was phase 3 vaccines. This is a table from Deutsche Bank over the various vaccines. And when I looked at this, I thought, actually, there must be something wrong, because I always thought there was 9 vaccines in phase 3 trials, and you see there's 8 there. But the reason why there's only 8 and not 9 is that the Russian vaccine, which Russia claims is in phase 3, the World Health Organization claims is in phase 1. So there's a difference there. The other point of interest is, depending on which one of these, who knows whether it will be one or more or a number, there's quite a large number which actually come from China. So there may be quite a difficult decision ahead for many Western governments if it turns out that Chinese phase 3 is ahead or more efficacious than other drugs, whether they'll buy those vaccines or not. Talking again against risk, and the other element with a lot of people talk about, obviously in the UK, and cite as one of the reasons for the UK stock market having performed very badly, is the uncertainty over the end of year, what's going to happen with the EU, what's going to happen with the trade agreement. Firstly, I would say, if you actually look at the UK stock market, more than 75% of revenues and profits actually come from overseas. So it does have an impact, obviously, on the UK economy, very importantly. But in terms of many of the companies actually capitalized on the UK stock market, and those largest companies like AstraZeneca, Glaxo, and BP, Shell, etc., they're less dependent on the UK economy than you might think. And the last time there was a major reaction was obviously 2016. So we can see, obviously, kind of history tends to repeat itself. What happened last time? Well, what happened last time was there was a dramatic sell-off in sterling, and actually, because the factor which I just said, a lot of the companies have huge overseas profits and revenues, their share prices actually went up. So there is a kind of inherent hedge, if you like. On the one hand, some positive arrangement between the UK and EU would be good in terms of, if you like, the valuation of UK equities and the fact that risk factor has reduced. On the other hand, if it isn't positive, and if there is a fall in sterling as a result, that will benefit quite a few of the largest companies. It obviously won't benefit, a lot of the smaller companies and a lot of the companies most exposed to that, whether it's a kind of domestic house builder or an airline company. But for those very largest companies, it will be different. So like all these things, there's normally pluses and minuses. And again, this goes back to the central principle of diversification. If you have a well-diversified portfolio, then you're going to mitigate these factors. Anybody who tells you they can predict whether, which one of these, or if any of them, vaccines will happen, when they will happen, what the final agreement will be, whether it's 100% there is going to be agreement or not. People will have their views. But when we're investing on the basis of what we know, how much it is contained in the price of something we're buying. And that's what determines it. We're all going to have our own individual views, but what we try and do is be dispassionate, look at everything on its own merits, and build a portfolio which is a resilient portfolio, which will offer highest returns, risk adjusted, by buying a well spread but undervalued portfolio of assets. One of the portfolios, we haven't launched many portfolios. Let's say that to start since we started. We started with basically 2 portfolios in 2009, and we increased it by a massive 1 in 2011. Recently, we added an ethical portfolio, and one of the reasons for that was that there's much more ethical exchange-traded funds than there have been prior to that. So prior to that, we refused to start a portfolio where we didn't think we could actually populate it with a good choice of underlying assets. And if you like, the red flags to the portfolio are quite similar to other managers. It doesn't invest in tobacco stocks, nuclear weapons, adult entertainment, gambling, or firearms. But within that, it has to be said, there is a lot of debate about greenwashing and companies which kind of might look like they're kind of ethical stocks, but when you kind of dig under the surface, they're not. There's also an issue that different providers of data will give completely different rankings to companies. Like recently, one provider ranked Tesla towards the top in terms of its ESG score, and another one towards the bottom. And one way we think it is the best way kind of to actually help investors, and again, I think we're almost unique in this worldwide, is that every month we publish the full list of all our holdings, because of course every single investor is going to have a different view on whether a particular company is ethical or not, and I think everybody should have the right to actually know what they're getting before they invest. Now, Boohoo was a very topical stock recently because of its various factories in Leicester and the issues that happened around that about a month ago. Now, interesting, there was quite a few ESG funds where the largest holding was actually Boohoo, and it represented for quite a few of these funds 3 to 4%. Now, within our portfolio, it was 0.1, so it was a tiny holding within one UK index fund. Lastly, performance. What we've shown since we started here is the performance of all our core portfolios. We've shown them after fees and charges. So this is not before fees and charges, this is the actual returns received by investors for the bond reserve, the absolute return and the long-term return. And they've all outperformed the typical private client portfolios, which are these ARC indexes. So what ARC does is it takes the portfolios from quite a few high-profile, kind of well-known wealth managers, asks for their returns, puts them into various baskets, so that you can actually compare it with the actual returns people receive. Whereas the problem with comparing yourself with a fund is that normally to access that fund, you normally have to pay other charges, whether it's the platform charge or advice charge. So it's comparing like for like, it's comparing the returns that people actually get from investing in our portfolios after all fees and charges with other wealth managers. And then just looking at sorry, just looking at rolling 12 months years, you can see what we've done is highlight in red the negative years. We're not hiding that, but for most years the returns year on year for the three core portfolios has been positive. And actually, if you look at the 12 months to August, and again for our type of investing, it hasn't been, if you like, the easiest, because we haven't had a large exposure to the US, we haven't had a large exposure to these tech stocks. So despite all that, partly through some well-timed tactical decisions like the hedging I talked about earlier in mid-March, we've mitigated some of those underlying factors that have been operating against us. And you can see the goal to investing, as I said, is keeping costs down, having a well-spread portfolio, and investing for the medium to long term, because it's very hard to predict the very short term.
Exit the screen. Go back. Thank you very much, Alan. So we'll now move on to some questions. At the bottom of your screens, you should have two icons, which is either raise your hand or chat. So you can either type a question for us, or you can actually raise your hand and we'll unmute you and hopefully get that question. But I want to start off with a question from Richard, Richard sent in saying, for the past year or so, I have kept a sizable sum in cash, awaiting, I suppose, a serious crash or something where I can take advantage of a great deal. With interest rates as they are now, and even negative rates under consideration, what might be an alternative strategy for this cash fund with the same sorts of objectives?
Okay. Well, I suppose the natural alternative for cash would be the bond portfolio, the bond reserve portfolio, which doesn't hold any equities at all. I mean, if you want to have something with a slightly higher volatility, but in the long term, I think you're going to get higher returns from equities than you will from bonds, then, we offer a kind of range of portfolios. So you could have something which is predominantly bonds, or have different levels of equities within that. As I said before, the yield on those underlying bonds is a bit 2.5% to 3% within our bond reserve. Now, there still will be volatility within that, because obviously that's partly determined by movements in long-term interest rates. And it's our view you'll get much higher returns on that than you will from either government bonds or cash, where, as you say, kind of cash doesn't really give you much of a return at all.
Okay, moving on to our next question. What contingency plans do you have in place if Alan was not around through illness or worst case scenario? Who would make strategic decisions and manage key investment decisions?
Am I answering, mate? So I'm
yes.
Not around anymore.
No, you're answering the
question. Okay. It's a very good question. I mean, kind of, firstly, there's three of us on the investment side here. Massimo is there, but Barnaby and myself. And secondly, if you look at what we're investing in, there's a different level of risk to a traditional fund. What happens in a lot of funds, you have a fund manager risk. It tends to be kind of just one or two people who actually manage a fund. No matter what the organization says, it's largely dependent on one or two. And a large number of the companies within it tend to be quite often idiosyncratic selections of that manager. So when the manager changes, the new manager sometimes doesn't really actually have a feel for those companies, and often there's huge amount of turnover with huge amount of cost. Now, if you look at what we invest in highly liquid instruments, and we invest in instruments which are very easy to analyze and very easy to access. So if you like, the difference between somebody else taking over our portfolios, whether it's somebody internally or externally recruited, or whoever it is, it's a completely different way to approach things than a traditional fund, which is, again, will have much larger exposure often to a number of small companies, be much more dependent on that individual manager, and won't have the breadth and the liquidity and the ease to analyze that we have within our funds.
Another question coming up, which says, let me get, there's quite a few coming through. Let me just one of these. Yeah, it says, I'm curious to know how many individual investors you have. So we don't tend to say individual investors, but we have grown our business now by about 300% in the last 2 months, it's sort of 12 months or so.
35%.
But 35%, but since we started.
Oh, okay.
Since we started. And in the last 12 months, about 35%. And we now have a range of institutional investors as well as individual, but we don't publish our individual numbers, if you like. Did you want to?
No, all I say is every single investor is treated the same. And in terms of the amount invested, it varies from literally kind of an ISA for £10,000 to investors with multi-million-pound portfolios. And there was no difference in terms of the actual portfolio the investor has. We believe that everybody should be treated the same, and everybody kind of same charges and actually has the same portfolio.
So yeah, so we don't bespoke, but what has changed as well is that our average size investment has gone up. So we're now close to about 300,000,
yeah.
our average size,
yeah.
even though our minimum investment level is £10,000. Let me just go to,
some more there.
Yeah, no, I've got some more here. We are almost certainly going to experience a second wave. We will see another significant drop in UK-US markets this autumn, or will we?
Yeah, I mean, it's very hard to kind of understand. There's a difference between the markets are basically a discounter of the future, and that future can extend quite a few years. So you can have situations where there's a lot of bad news, you're reading lots of bad news, you're kind of, you know, every time you see Valance or Whitty, there's obviously bad news, but all the 10 o'clock news. But that doesn't mean that markets are going down, because the question is what is built into the valuations and what is built into expectations. So just as I showed before, you know, when we were sitting in mid-March, April, then actually people were expecting a much more dramatic fall in terms of economic growth and corporate profits falling than has actually transpired. It's not to say that there's not going to be future changes, but you can't say that the link, as I said before, the link between GDP growth and share prices is actually very low. The most important is how much you pay for something. And I wouldn't rule out second waves. The question is, you know, the market will obviously in the short term move about in quite often kind of currently whether the latest vaccine is successful or not successful in terms of treatment, in terms of the extent of economic shutdowns, whether there's likely to be more measures. And of course that will have an impact on the short term. But when you're investing, if you're investing in a company, you're investing in a medium to long term. And whatever happens to as long as the company is there to come out the other side, the question is, what kind of company are you going to get? How much profits are you going to get from that? How much revenue? How much cash flow? And those are the important determinants. So if you're actually buying those multiples cheaply, then you should actually receive higher returns. I know it's hard to kind of think like that when you're kind of being, every day there's there's more doom and gloom, but you have to kind of be dispassionate. It may be there's points where actually the share prices don't reflect the full doom and gloom over a long-term basis, and there's going to be times of the opposite's true. At the moment, outside the world of, you know, some of the tech stocks like Tesla and Apple, etc., there's not a lot of hope being kind of baked into quite a lot of company valuations. And the companies that we invest in are not highly valued. And the bonds that we invest in are not these bonds which give you no return. So that's why I'm optimistic. It's not because I'm some kind of blind optimist that we're not going to have a second wave, or a lot of people may not take the vaccine, or there'll be other factors. But eventually we'll come through this, and eventually the valuations will reflect the underlying values of the companies and the underlying value of those bonds.
Okay, I'm going to fire some quick fire ones,
okay.
fairly quicker, because they're coming through quite fast. What is the difference between our style of investing versus, say, the Woodford Fund when it existed?
Well, how long have we got?
I said a quick fire answer, but
okay,
yes.
quick fire. No unquoted.
Yeah.
No companies listed on the Guernsey Stock Exchange. Hello, FCA. No, liquidity. We did analysis on Bloomberg a long time before it got suspended, showing actually it would take years to wind up that fund. With ours, the ETFs are incredibly liquid, and if every investor wanted to liquidate, we could do that incredibly quickly and at very low cost. In terms of diversification, obviously we have thousands of companies. They're predominantly large cap liquid companies. I mean, the difference is about as big as you can get.
Okay. What will the US election result mean for next year?
It depends what it is. At the moment, there seems to be kind of, I think the polls are predicting a Biden victory, but the betting in the States seems to be more even between the two candidates. Now, if there is a Biden victory, I would have thought that's going to be probably quite bad for quite a lot of the tech stocks, and is also probably more likely that there will be some of the tax reductions which Trump put in will gradually kind of come off. It may not be the best time to come off immediately because of obviously the economic situation we are in today. And I would have thought that's probably going to, if you like, accelerate the trend which has started about a month ago. Now, if Trump wins, no doubt there will be more worries or more volatility around kind of trade agreements, particularly between the US and China. And whether one is necessarily worse or better than the other, everybody will have their own view. But I think in terms of our portfolios, we don't have a large exposure to the US market. We don't have a large exposure to US tech companies.
Okay, I'll try and squeeze in a few more. I regret not riding the FANG Plus recovery wave since March. SCM didn't either. Was this a mistake?
Yes. I mean, I'm the first to say that was a mistake. But the way we look at things is we always invest on the basis of fundamentals. It's very easy, or it's not very easy as far as I'm concerned, but it's very easy to buy something simply because it's going up. And the problem is you've always got to find somebody willing to pay a higher price than you. And the higher the multiple, the higher the valuation, the more dangerous it is. And that's not a risk I'm prepared to take.
Okay. If there is a drop in sterling with a no-deal Brexit, would it be better for a UK investor to invest in your euro-denominated portfolios as opposed to sterling-denominated?
On the basis of that currency factor, yes, because that would imply a fall of probably the pound against euro. There might well be a bigger fall of the pound against the US for US. So you could argue that the US portfolio might actually benefit more in terms of currency. But then within that, you have a bias towards European equities within the European portfolio and a bias towards US equities within the US. So once again, there will be probably different counteracting factors, but you're right.
And then, do you think that the UK economy is going to do badly in the next 12 months? And if so, how are we skewed, or how are you skewing your funds towards UK companies that earn their profits outside the UK?
Well, yes, we are skewed, but the UK market is an unusual market. It's very dominated by those large companies. They are international companies. They are, as I've talked about before, predominantly overseas earnings. So there is a natural hedge in that. And we're not, whilst we bought some mid-cap stocks recently, we still have the vast majority of exposure within those largest companies.
One, if we go into lockdown, will SCM, or close to lockdown, will SCM staff be working?
We'll be working. We've always been working, yes. I mean, we, like before, we have the ability to work from home. Actually, personally, I think there's a lot to be said. If you've got a business which revolves around, if you like, intellectual capital and conversation and debate, then I do believe it helps being in the office, and that's where we are at the moment.
Yes, and we've actually been back since the beginning of June with full protection for our staff, and we'll carry that going as long as possible. But even if we're working remotely, everyone has access, and obviously we will be working full time on the portfolios. So I think that's about as much
Wasn't there
time.
some gold or commodities?
There's one about commodities. Let me just get that one. Yes, precious metals. There was one about precious metals. Let's see if we can. That was quite an early one. So if we can fit that one in. Ah, yes. What do you think of precious metals and precious metal equities as assets in portfolios?
Years ago, when the gold price was very high, although all fund managers told everybody that they needed to buy gold because it was a diversifying asset and they should have up to 10% of the portfolios in gold. And then, of course, the gold price then collapsed. And I think they kind of, from my memory, if you like, the warning bell was when, I think in the Middle East, they put a kind of gold cash point machine where you could put money in and get your gold bars. And if ever there was a warning bell, to my mind, at the top of gold. Now, at the moment, a lot of investors have got gold and very keen on gold, and that's all well and good. But within our portfolios, we like to buy assets that actually pay the investor. By buying bonds, by buying equities, you're getting a return in income every year. And that's something kind of, the problem about buying commodities is firstly, the returns tend to be quite volatile. You can have quite a number of years where the returns are basically zero or negative, and then a few bumper years. And anyone who, again, who says they can predict those few bumper years is probably unusual, or either very small in number or small in terms of truth versus deception. And if you look at, the returns from gold, for example, the long-term returns haven't been great, but we've had fantastic returns in the last few years. We had very bad returns for quite a number of years, 5-7 years before that, and then I had a very good return, as I said, during that kind of gold bubble last time. So we have invested in commodities from time to time. It's never been a very high exposure, but we believe the main asset for our portfolio should be something that actually pays you.
Well, quite remarkably, I think we've managed to do our session with 2 minutes to spare. So thank you everyone for dialing in and joining us today. If anyone would like a recording or a copy of the presentation, then please let us know. We probably will be sending out the presentation anyway, but if you'd like a recording as well, please let us know at inquiries@scmdirect.com. And any other questions that you have thought of after or whenever, then, as I said, the team is here and willing to help in any way we can. So again, thank you very much and keep safe.
Thank you.
Bye.
Bye-bye.